Have you ever wondered why getting approved for a mortgage can feel like winning a major life battle, but the moment you sign the paperwork, someone else seems even happier than you are? Most people believe a mortgage is simply a loan that helps them buy a home. A necessary step toward the American dream. But what if your mortgage isn't just helping you build wealth? What if it's also one of the most valuable financial products a bank can own? By the end of this video, you'll understand why banks don't just lend money for homes, they build entire business models around mortgages. And once you see how the system works, you'll never look at a monthly mortgage payment the same way again. Welcome to Money Explained Differently, where we uncover the hidden side of money and explain the financial stories most people never see. Imagine a young couple named David and Emily. After years of renting, they finally save enough for a down payment on their first home in Ohio. They spend months touring neighborhoods. They imagine birthdays in the backyard, Thanksgiving dinners with family, and watching their children grow up under one roof. When the bank finally approves their mortgage, it feels like a dream come true. The loan officer shakes their hands. The realtor congratulates them. Friends celebrate. Everyone tells them they now own a home. But in reality, they don't fully own it. Not yet. For the next 30 years, another name has a very important claim on that house. The bank. And here's where the story becomes much more interesting. Most people think banks make money simply because borrowers pay interest. That is true. But it's only the first layer. The real business goes much deeper. Think about what a mortgage actually is. A bank gives you hundreds of thousands of dollars today. In return, you promise to make monthly payments for decades. Not weeks. Not months. Decades. That's an incredibly predictable stream of income. Imagine owning a business that knows exactly how much money thousands of customers will likely pay every month for the next 20 or 30 years. Very few businesses enjoy that level of predictability. Restaurants don't. Retail stores don't. Technology companies don't. Customers may disappear tomorrow. But mortgage borrowers usually stay for years because moving is expensive, refinancing takes work, and people naturally want to keep the roof over their heads. That stability is one reason banks value mortgages so highly. But this is where most people get surprised. Banks often don't keep every mortgage they create. Many people picture a mortgage staying inside the same local bank forever. That isn't always what happens. After approving your loan, a bank may sell it to another financial institution or bundle it with thousands of other mortgages. Those bundles can eventually become investments purchased by pension funds, insurance companies, and large institutional investors. Your monthly payment may still go through the same company you recognize. But behind the scenes, ownership of that loan may have changed. This process gives banks something extremely valuable. It allows them to recover much of the money they originally lent so they can issue more mortgages. Instead of waiting 30 years to get all their money back, they often receive fresh capital much sooner. It's a bit like a bakery selling today's bread, collecting cash, and immediately using that money to bake tomorrow's bread. The faster the cycle continues, the more business the bakery can do. Banks operate in a similar way with lending. However, there is another side to this story. If banks can sell mortgages, why do they care whether borrowers make payments? Because every mortgage starts with trust. A bank wants borrowers who are likely to pay consistently. That's why lenders spend so much time checking credit scores, income, employment history, debt levels, and other financial information. It isn't because they're trying to make life difficult. They're trying to measure risk. Every missed payment creates uncertainty. Every foreclosure costs time and money. Every default reduces profits. The ideal borrower isn't necessarily the richest person. It's often the most reliable one. Someone with stable income, reasonable debt, consistent payment habits. Predictability matters more than flashy wealth. That's a pattern you'll notice throughout finance. Reliable cash flow usually beats unpredictable opportunity. But the biggest cost is not the one you can see. When most buyers look at a home, they focus on the purchase price. Maybe it's a $400,000 house. They compare that number with similar homes. They negotiate. They celebrate saving a few $1,000s. Yet the purchase price is only part of the financial story. The financing matters just as much. Sometimes even more. A mortgage stretches payments across many years. Interest is the price of borrowing that money over time. In the early years of many traditional mortgages, a larger share of each monthly payment goes toward interest than toward reducing the loan balance. Over time, that gradually changes, with more of each payment going toward the principal. Many first-time homeowners don't realize this until they review an amortization schedule. It can feel surprising to discover that after several years of payments, the remaining balance hasn't fallen as much as they expected. That doesn't mean the mortgage is unfair. It's simply how long-term loans are structured. The bank provided the money upfront and charges for the time that money remains outstanding. Understanding that structure helps explain why making extra principal payments, when affordable and allowed, can reduce total interest over the life of the loan. But there's an important balance. Not everyone should rush to pay off a mortgage early. Some households benefit from doing so because it reduces debt and provides peace of mind. Others may decide that investing extra money elsewhere better matches their long-term goals. The right answer depends on income stability, interest rates, emergency savings, retirement planning, and personal comfort with debt. There isn't one perfect choice for everyone. And that's something many financial discussions forget. Now let's step outside the mortgage world for a moment. Have you noticed how many companies encourage monthly payments? Streaming services, phone plans, software subscriptions, car financing, even furniture. Why? Because recurring income is incredibly valuable. Predictable revenue helps businesses plan hiring, expansion, technology investments, and future growth. Banks love mortgages for many of the same reasons. Instead of hoping customers return every month, the payment schedule is already built into the agreement. That consistency makes planning much easier. But this raises another fascinating question. If mortgages are so valuable, why don't banks approve everyone? Because lending isn't simply about collecting interest. It's about balancing opportunity against risk. Imagine lending someone $300,000. If everything goes well, you receive steady payments for years. If things go badly, recovering that money can become expensive and time-consuming. Foreclosure isn't a financial victory. It's usually considered a last resort. Properties may lose value. Legal costs add up. Maintenance expenses appear. Homes may sit vacant. Banks generally prefer borrowers who continue making payments rather than taking ownership of houses. Despite popular myths, banks aren't in the business of collecting homes. They're primarily in the business of lending money. And performing loans are usually more valuable than empty properties. What do you think? If you suddenly had enough money to pay off your mortgage tomorrow, would you do it immediately, or would you invest that money elsewhere? Share your opinion in the comments. There isn't a single correct answer, and it's always interesting to hear different perspectives. Now let's explore another hidden part of the story. Interest rates. Most people think of mortgage rates as numbers on a website. 6%, 7%, 5%. But those percentages quietly shape entire economies. When rates are lower, borrowing becomes more affordable for many people. More buyers may enter the housing market. Demand can increase. Home prices sometimes rise. Construction companies build more homes. Furniture stores sell more products. Moving companies become busier. Mortgage lending connects with many parts of the economy. When rates rise, the opposite can happen. Monthly payments become larger for new borrowers. Some families decide to wait. Housing activity slows. Businesses connected to housing may also feel the change. A single interest rate influences far more than one monthly payment. However, there is another side that often goes unnoticed. Banks don't control every interest rate. Their lending decisions are influenced by broader economic conditions, competition, funding costs, inflation, and monetary policy. In other words, banks operate inside a much larger financial system. They're powerful participants, but they aren't writing every rule. That's why mortgage rates can change significantly over time, even if the same borrower applies for the same home years apart. Now consider something even more personal. Your behavior after getting a mortgage. People often become extremely careful about protecting their credit. They avoid missed payments. They think twice before taking on unnecessary debt. Some delay changing jobs until after closing. Others build emergency savings because they never want to risk losing their home. The mortgage changes financial behavior. And from a bank's perspective, that's valuable. A customer making regular payments, using checking accounts, maintaining savings, purchasing insurance products, or eventually refinancing creates a long-term relationship. Banks don't only see a mortgage. They often see decades of customer interaction. This doesn't mean every bank is trying to maximize every dollar from every customer. Competition between lenders is real. Borrowers compare rates. Some refinance. Others switch banks. The financial relationship goes both ways. Consumers have choices too. And informed customers often negotiate better outcomes. But here's a lesson that extends far beyond mortgages. The products companies promote most heavily are often the ones that create long-term value for the business. That doesn't automatically make those products bad. A mortgage can help families build equity instead of paying rent indefinitely. Owning a home may provide stability, personal freedom, and long-term financial benefits for many households. The key is understanding why the product is valuable to both sides. When you recognize both perspectives, you stop seeing yourself as just a customer. You begin seeing the incentives behind every financial decision. That's one of the most powerful ways to improve financial thinking. Ask not only, "What am I getting?" Also ask, "Why is the company so eager to offer this?" Sometimes the answers reveal opportunities. Sometimes they reveal hidden costs. Usually, they reveal both. Before we finish, let's return to David and Emily. 30 years sounded overwhelming when they first signed their mortgage papers. The monthly payments felt endless. But each payment slowly increased their ownership in the home. They maintained the property. Raised a family. Weathered economic ups and downs. Over time, the house became more than a place to live. It became an asset. Meanwhile, the bank earned income for providing the financing that made the purchase possible. Both sides benefited, but in different ways. The bank gained a reliable financial asset. The family gained a place to build a life and, eventually, full ownership of their home. That's the hidden truth. Banks love mortgages because they're designed to create long-term, predictable financial value. Homeowners love mortgages because they make homeownership possible years before most people could ever save enough to pay cash. Neither side is necessarily wrong. They're simply pursuing different goals. The smartest borrowers aren't the ones who fear banks. They're the ones who understand exactly how the relationship works. Because once you understand the incentives behind money, you stop making decisions based only on emotion. You start making them with clarity. And that may be one of the most valuable financial skills anyone can develop. If you want to discover more hidden truths about money, subscribe to Money Explained Differently. We explore the financial stories behind the decisions that shape everyday life. Because sometimes, understanding how money really works is worth far more than the money itself.